Assalamu alaikum, ma'am.
Walaikum assalam, Mariam. How are you?
I'm fine, alhamdulillah. How are you, ma'am?
Alhamdulillah, I'm good too. In the last task, we completed the task number one, which was supported by lecture number one and lecture number two. And technically, today we are having lecture number four for this course. After this
Okay.
lecture, like in the next class, we will be having task number two. In that task two, we are having these assessment criteria. So the slide supports only these data, assessment criteria only.
Okay.
Yeah.
Okay.
Okay. Let's begin with the lecture then. Be able to analyze financial data for an organization in order to inform strategic decision making purposes. Again, we have to focus on the commander, but this is not in the task. It is just for the general knowledge that what actually the learning outcome number two is going to be about. So it is all about the financial data, that is the statements which basically supports the strategic decision making process. Analyzing the financial data for an organization to inform the strategic decision making involves understanding the financial health of the organization, identify the key trends, that is your what your rivals are doing, what the industry is going on through at the moment, and using this information to make the informed choices that align with the organization's objective. That is the strategic decision making, your financial data, plus the organization's objectives, rules and regulations, mission statement, everything should be aligned together. So only then we can able to compete in the market. Now, these are a few steps through which we can do this. The first is gather and review the financial statements. Obtain the organization's financial statements, including the income statement, balance sheet, and cash flow statement. When we are going to analyze all of these statements all together, then we would know that what is happening inside the organization. For example, if we discuss about the income statement, we would know that what is the net profit for the specific 6 months period or for the whole year. Or we can have a loss, a net loss as well. Conduct the ratio analysis. Now calculate and assess the key financial ratios such as liquidity ratios. This will depict that how much cash and liquidate is your organization is. Profitability ratios and solvency ratios as well. These ratios provide insights into the organization's ability to meet the short-term and long-term financial obligations, its profitability, and its overall financial stability as well. Then we have compare performance over time and industry benchmarks. Now, by evaluating the financial performance with the several periods of time, we can identify the trends and patterns of the various organizations in comparison. Now, the organizational financial ratios and performance with the industry benchmarks is to gain a broader perspective. What is a benchmark? That is a unique point of your organization, which makes you stand out among the others. Assess the cash flow and working capital. Examine the organization's cash flow to understand its ability to generate cash and manage its operating, investing, and financing activities. Evaluate the adequacy of the working capital to support day to day operations and growth initiatives. Now, this is again a whole definition of a working capital itself. Why we do working capital? It is just to support and to know that what is happening on the daily basis in the organization. Identify the cost drivers and cost structures. Now, the cost structure to identify the key cost drivers and the areas where the cost can be optimized. That is, we should know as a manager, as a senior MD, that where we can optimize, scrutinize the cost, and can invest in other projects or in other departments of the organization. Then perform the break-even analysis and profitability analysis. Break-even analysis is when your sales revenue meet your cost. Calculate the break-even point to understand the minimum level of sales required to cover the costs. Conduct a profitability analysis to assess the contribution of the different products, services, or the business segments to the organizational overall profitability. And I'm sure you know that what break-even is, right?
Break even analysis.
Yeah, like a break-even itself, what it is.
No, ma'am.
Okay, wait. Even in the paragraph, it is clearly written that it depicts the minimum level of sales required to cover the cost. Whenever we make a product, it has a certain cost, right? For example, $50. We are having a sales of, for example, 1,000 sales per product, like per batches of the product. When we are covering the cost and the extra amount we get, that is the profit. That is why we calculate the break even. It is very simple.
Okay.
And in task 5, we will be
Okay.
calculating the net present value and break even, so you will have a whole view of it as well. So, not to worry.
Okay, ma'am.
Then communicate findings effectively. Present the financial analysis findings in a clear and concise manner to key stakeholders such as executives, board members, and investors. Obviously, whatever the steps we have followed above in the slides, they were all related to the financial health for the business, for the organization, in relation to the strategic decision making. When we are going to communicate, transfer our findings, and we will be giving the feedback to the board of directors and the higher authority members, definitely they are going to take the action according to it. And by following these steps, what we're going to do, we are going to contribute to the overall success of the business, that is in the strategic decision making and sustainability of the organization. Then we have assessment criteria 2.1. Interpret financial statements to assess the viability of an organization. What is interpretation itself? Interpretation is a detailed explanation of the financial statements, and we know financial statements are the income statement, balance sheet, and the cash flow statement. And what we're going to do in this, we're going to assess the viability of an organization, how it depicts the performance of the organization. Now, here is a guide to interpreting the financial statements effectively. Again, these all points, the published accounts, that is the purpose and users, and further in 13 and 14, 15 slides, all the points are mentioned in the indicative content. I have only given explanation. And when we will be doing the task number 2, it will be according to the Samsung company. You remember that link which it is in your assignment in the context.
Yes, ma'am.
So
Yes, yes.
that this task is all about that. So we will be discussing in detail the financial report of that organization, Samsung. So it's going to be interesting as well,
Okay, ma'am.
dealing a number. Okay, the purpose. Now, the published accounts, including the annual reports and the financial statements, serve the purpose of providing an overview of the company's financial performance, position, and cash flow. They help stakeholders make informed decisions about the company. So, this is the main purpose why we make these statements, because only then the stakeholders, the board of directors, are going to be informed that what is happening inside the organization. Do we require more investors? Are we defaulting? Are we processing towards upper hand or not? Users. Various stakeholders utilize these accounts. These can include the shareholders, investors, shareholders, the potential one, managers, employees, lenders, creditors, suppliers, customers, the community, and competitors. Basically, each and every group in the world, in the country, is associated with the specific organization because they have bought, if they have purchased a share in your organization. They're going to be way too interested in your organization to know that what actually is happening inside. Then we have annual reports and financial statements, the content of it. The annual report typically includes the main financial statements such as the balance sheet, which is known as the statement of financial position, income statement, which was previously known as profit and loss account, statement of cash flows. It contains the director's report, audit report, and notes to the accounts, providing further context and explanation of the financial data. Once, if you go back, if you remember that Samsung financial report, which we downloaded through the internet, it was just numbers. But this is the responsibility of the auditors and the senior directors. They are going to explain each and everything, how the sales ratio was this, the number came to this, how many products were actually sold. Each and every explanation is going to be given in those supporting notes. The structure of the financial statements. Each financial statement has specific requirements and must adhere to the accounting standards to ensure the accuracy and comparability. Me, you, nobody can change that accounting standards. They are set by the accounting body, and we have to fulfill and follow each and everything according to it. For example, the balance sheet presents the company's assets, liabilities, shareholders' equity at a specific point in time, whereas the income statement shows the company's financial performance over a specific period. And for a specific period, it means it can be for the 6 months, it can be for biannually or annually, that is after 12 months. We get to know that what is the net profit of the organization or net loss, Plus, we get to know the expenses in the income statement and the gross profit as well. Clear, Miriam?
Yes, ma'am.
Then we have internal management accounts versus published financial accounts. So, what are internal management accounts? These are used for the internal decision making and may include more detailed and frequent financial information, such as monthly or quarterly reports. Like after each and every month, we're going to have a meeting with the employees, with the senior MDs in the organization internally. Not external bodies are included in it. And we will be discussing that how we can improve further and how we can grab the consumers or the stakeholders and anything. They may provide insights that are not disclosed in the published accounts. Obviously, this is way too obvious and clear that first we are going to discuss the report monthly or after 4 months, that is the quarterly basis, with our own organization people, not with the outsiders, because if they know the negative points or the mitigating risk of our organization, definitely they are not going to be interested in doing further investment with us. And the published accounts are the vice versa of it. They provide a more general overview and are the subject to regulatory requirements and auditing standards. We cannot change them. We have to provide the statement in the stock exchange, like the one which we downloaded through the Samsung website. It was a published financial account. Anybody can access it, but the internal world can only be accessed by the internal authority. Limitations of published accounts. Historical data. Published accounts primarily provide historical financial information and may not reflect the current market conditions or the future prospects accurately. That is the main drawback of it. Or you can say a disadvantage. Why? Because we are making each and everything from the past data, from the previous year. Use of estimates. Now, they often involve the use of accounting estimate, judgments, and assumptions which can affect the accuracy of the reported figures. That is again true. Like whenever we calculate the discounting factors in the accounts related to the cash flow statements and net present value, uh, doing extrapolation, what happen is we always get a rounded figure. So it's not an accurate one, and in the end, the answers always comes differently. Emission of non-financial information. Now, they may not include crucial non-financial information, the published accounts. However, the published account, the internal management accounts, they do include it. What is in the published accounts? Such as market trends, competitive analysis, qualitative factors which can impact the company's future performance. By considering these aspects when interpreting the financial statement, stakeholders can gain a comprehensive understanding of an organization's financial health and make informed decisions regarding the investment, loans, or partnership. So, learning outcome number two, AC 2.1 is clear to you, Mariam? Any questions?
No, ma'am.
Okay, that's great. Conduct comparative analysis of the financial data using ratio analysis. Now, in the main task, we will be directly doing it from the Samsung organization, which will be requiring a little bit of calculations, but that is going to be way too easy. We will be only using the numbers, picking out the numbers and just interpreting them. I'll totally guide you. For that, we
Okay,
will
ma'am.
discuss how we can do this. Here is how you can conduct a comparative analysis effectively. Comparative analysis techniques. The first one is comparison between years. The financial data of the organization over the several years to identify the trends and patterns in performance. The key financial ratios such as the liquidity ratios, profitability ratios, solvency ratios, and the different periods to understand the company's financial trajectory. Now we can only compare and get to know that what is happening inside the organization by calculating the ratios. Now there are gross profit margin ratio as well, current asset ratio as well. There are many ratios. So when we solve them, we calculate them, we get to know that what is the financial health of the organization. Then comparison between the business. And between the years mean we are going to compare it from the previous year to the current year, that is 2022 with 2023. With the business, it says that with those of its competitors or similar companies within the industry, we are going to compare. For example, I also make bread and the other company is also making a bread. So we are going to have a comparison between two of us because our product main line is same. This helps to gauge the company's relative performance and market position as well. Industry comparison. Benchmark the company's financial ratios against the industry averages to understand how it fares in comparison to industry standards. This provides insights into the organization's competitiveness and efficiency within the industry. So this is the whole benchmark when we are going to compare each and everything according to the industry. Industry could be of anything, for example, electronics to electronic industry. Then benchmarking. Using the benchmarking to identify the best practices and performance standards within the industry, compare the organization's financial ratios with those of industry leaders or top performing companies. Now, are you getting the point of benchmarking, like what actually it is? Why we do this in the organization?
Yes, ma'am.
Okay, that's right. Key financial ratio for the comparative analysis, liquidity ratios. Now, what it is? It assesses the company's ability to meet its short-term obligations. Company liquidity ratios, the common liquidity ratios include the current ratio and the quick ratio. Now, by the name, you must be afraid that what these are, but these are simply calculations of current assets and current liabilities. Once we will be doing the task in detail, I'll let you know that how we calculate this. Profitability ratios. What this ratio do? Evaluate the company's ability to generate the profits from its operations. Key profitability ratios include the gross profit margin, net profit margin, return on assets, and return on equity. These are the sub lanes of this particular ratio. Then we have solvency ratios. This include measures the company's long-term financial stability and its ability to meet long-term obligations. Solvency and liquidity both are same. They both means that how the organization is having, like how much organization is having cash in hand. The only difference is the liquidity covers the short term and the solvency covers the long term obligations. They include the debt to equity ratio and interest coverage ratio because we are dealing with the long term stability. Efficiency ratio. It analyzes the company's operational efficiency, that is, the day to day operations and effectiveness in utilizing its assets. It includes the asset turnover ratio and turnover ratio of the inventory as well, the stock which we are having in the warehouse. Assess the competitive position. Evaluate the company's competitive position within the industry based on the comparative analysis result. Identify areas where the company outperforms its competitors and areas that require improvement. It is just like when we check your assignments. The area where you just outperform, we always say that you guys don't need any improvement, you did very well. But when there is an improvement needed, we do highlight you have to correct that part or further improve that problem. Set realistic goals. Use the findings from the comparative analysis, that is comparing with the other organizations. It can be industry as well, and it can be the other organization. To set realistic and achievable financial goals and targets for the organization. Develop strategies to improve the company's financial performance and a position based on the identified areas for improvement. By concluding a thorough comparative analysis of the financial data using ratio analysis, stakeholders can gain valuable insights into the company's financial performance, position, and competitive standing within the industry. Uh, I hope AC 2.2 is clear as well.
Yes, ma'am.
That's great. Moving towards the last part, it is from the merit part. Make recommendations to an organization based on the analysis and the interpretation of the financial information. So we are going to recommend in this task, specifically in this merit part, on the basis of an organization analysis and the detailed interpretation of the financial information. How we are going to do this? There are some key recommendations. Enhance working capital management. If the analysis indicates inefficient working capital management, recommend strategies to optimize cash conversion cycle, streamline inventory management, and improve accounts receivable and payable process. Working capital, I told you, it is the one in which we do day-to-day calculations of our cash flows. How much money is coming in, how much money is going outside, what is happening in the organization. When we're going to control each and every department, that is the inventory management one, and then the accounts receivable, the cash which we are receiving, and the cash payable, the one which we have to pay further, then we can definitely ensure the working capital management. This will ensure the sufficient liquidity for day-to-day operations and reduce the need for external financing. When we're going to have enough finance within the organization, then this means we don't require an extra loan or investment from other people for the short-term task. Cost control and efficiency improved. Identify areas where cost can be minimized without compromising the quality of products or services, such as renegotiating the supplier contracts. We always have a very crucial relationship with the supplier and the producer because as a producer, we don't pay the supplier on time. This is an always meant to be from a long history problem in this nation. So that is why we're always having a liquidity problem with them. Implementing the lean manufacturing practices or investing in the tech to automate and streamline the process. This is how we can control and improve the efficiency of the production. Revenue growth strategies. Develop recommendations to increase revenue by exploring new market segments, introducing new products or services, or expanding geographically. Now, it would be requiring the customer needs and preferences, developing the targeted marketing and sales strategies to enhance market penetration and customer acquisition. Revenue growth strategies. Like what we can do is we can merge and acquire another organization. Plus, what we can do, we can conglomerate. For example, I am making pharmaceutical products and now I'm making the manufacturing product as well. Both of the fields are way too different, right? The whole industry is different. That is what a conglomerate is. And can do that just to gain more revenue. It's a strategy. Debt management and capital structure optimization. Evaluate the organization's debt level and recommend strategies to manage the debt effectively. This may involve refinancing the existing debt at lower interest rate, negotiating the favorable terms with the creditors, or restructuring the company's capital to achieve an optimal debt to equity ratio. That is how much your company is in debt. You know what's the meaning of debt, right?
Yes, ma'am.
Okay. And equity is the capital. So it's better, we should always have more capital in the organization, that is more money in the organization than the debt. Any organization they don't want that they should be in debt. Why? Because ultimately they will default. So it is more optimal that we should have more capital in the organization rather than debt. Then we have investment and expansion decisions. Based on the financial analysis, provide recommendations on the potential investment opportunities or expansion initiatives that align with the company's growth and financial capabilities. Obviously, as an organization, we should make those decisions which help us to move towards more investment and expansion. And how we are going to do that? By jumping upon those opportunities which help us to grow more. Operational and process improvements. Identify the operational inefficiencies and recommend process improvements to enhance productivity and reduce operational costs. Operational cost is the one which we are doing on a daily basis, the daily expenses, and we should reduce them so that we should have more house for the profit. And how we can do that? Implement the performance measure statement, that is the key performance indicator KPI, to monitor and evaluate the effectiveness of the operational improvements over time. For doing further, like specifically doing the operational process improvement, there is a measurement key that is called KPI. Then risk mitigation strategies. The organization exposure to financial and operational risk and recommend risk mitigation strategies. Develop the risk management protocols such as hedging the strategies, insurance coverage, and contingency planning to minimize the impact of potential risk on the organizational financial performance and stability. By eliminating the risk using various strategies, including the contingency and the insurance one, we can definitely grow further and we can reduce the risk of defaulting. Long-term financial planning. Develop a comprehensive financial plan that outlines the organization's long-term financial goals and objectives. including the strategies which are achievable for the sustainable growth, maximizing the shareholder value, and ensuring the financial resilience in the face of economic uncertainties and market fluctuation. Now, we as an organization, if I open a small company, my long-term objective is going to be that I want to protect my organization and I want to grow further. That is profit maximization and penetrating in the market is my main objective. Why? Once I am standing in the market, in the industry, then nobody can kick me out until and unless I do something foolish. Maybe I'm not moving or taking enough measurements which are related to tech. So, long term financial planning is way too necessary for any of the organization. Then corporate governance and compliance. Provide recommendations for strengthening corporate governance practices and ensuring the regulatory compliance. Suggest measures to enhance transparency, accountability, and ethical standards within the organization to build investor confidence and maintain the stakeholder trust. And this can only be achievable by providing them the correct reports and making your organization enough efficient that they provide correct and authentic data reports to the stakeholder bodies. Now, by implementing these recommendations, the organization can improve its financial performance, strengthen its competitive position, and achieve sustainable growth and profitability in the long run. It is essential to regularly monitor the implementation of these recommendations and adjust the strategies based on evolving market dynamics and internal business conditions. It is not necessary we are going to stick to only one strategy or one compliance authority. We can change it over a period of time. Why? Because it depends on our business. We are the sole authority or the decision makers of the organization. When we have to change the any strategy according to the trend going on in the market, we should go for it. Clear?
Yes, ma'am.
Okay, I added a few real life examples according to these assessment criteria so that it's easy to even understand each and everything. For example, if we want to interpret the financial statements to assess the viability one, I chose Tesla. Now, Tesla, according to the profitability analysis, Tesla's improving net profit margin over the past few years demonstrates the company's successful cost management and increasing market trend demand for its electric vehicles, indicating strong profitability in the electric vehicle market. And I'm sure this is clear because it doesn't need enough explanation. It's just an
Yes,
example,
ma'am.
and it's a real example.
Yes.
Then liquidity assessment, what Tesla is doing for that. Guaranteed quick ratios indicate healthy liquidity, allowing the company to meet its short-term obligations efficiently, reflecting strong operational management and effective cash flow management strategies. Obviously, liquidity assessment is also good for the Tesla. Debt analysis. Despite Tesla's substantial long-term debt, the company's innovative growth strategies and successful capital raising initiatives, such as issuing convertible bonds, have supported its expansion plans, enhancing its overall financial stability. Although there is a debt for Tesla, definitely because it was a small organization, then it is now an MNC for the niche people, but you can see how he recovered it by using the convertible bonds plus using the expansion plans all over the world. Then conducting comparative analysis of financial data using ratio analysis. This is, I think, AC 2.2. For example, Walmart versus retail industry averages. Profitability ratio comparison. Walmart consistently higher net profit margin compared to the industry average highlights the company's effective cost management, economies of scale, and competitive advantage in the retail industry. Like for a general Pakistani person, a person like a brown person in Walmart, specifically in Canada, they give them, other than the benefits, their monthly payment is 5,000 Canadian dollars, which is approximately 15 lakhs Pakistani rupees. That's a lot. And you can imagine that the whitish people, the way they work in the Walmart, how much they're gonna get paid. So that is why they are like making their organization free of racism as well. Liquidity ratio comparison. Walmart's strong current and quick ratios compared to the industry averages reflect the company's robust financial position, efficient inventory management, and strong bargaining power with these suppliers. See, they're having conflict between the suppliers and producer nor with the consumers, enabling it to maintain adequate liquidity for the operational needs. Solvency ratio. Walmart lower debt to equity ratio compared to the industry average demonstrate its prudent debt management and sustainable capital structure, indicating a lower financial risk and stronger long-term solvency. Then, making the recommendation based on the analysis and interpretation of the financial information, this is the merit part. For example, Apple cost reduction strategy. With the focus on operational efficiency, Apple implemented cost reduction measures by optimizing its global supply chain, negotiating favorable supplier contracts, and enhancing the manufacturing processes, leading to improved profit margins and increased profitability. And that is way too true. We can even see that from the launch of the iPhone 15. Lastly, market. This is the point of the same example. The Apple One Market Expansion Initiative. Apple's strategic decision to diversify its product portfolio beyond the iPhones into services, wearables, and digital content allowed the company to tap into the new market segment, expand its customer base, and reduce its dependence on the iPhone sales, leading to sustained revenue growth and increased market share. This is the best strategy they can or any tech organization can use. Their sole purpose is not only on iPhones, but the other factors and the other products as well. However, if we compare it with the Nokia that back in 90s, they were only making phones, despite having 40% of the market share of the whole industry. Lastly, we are having working capital management plan. Now, the Apple robust the working capital management strategy, including the effective inventory management, stringent account receivables and payables monitoring, and prudent cash flow management, enabled the company to maintain a strong financial position, ensuring a stable cash reserve for the future investments and research and development initiatives. That's it. Any questions, any problem you want to ask?
No, ma'am. The slides were easy to understand, but once I'll start with the this thing task, then if I'm finding the difficulty, I'll let you know, ma'am.
Okay, sure. And even for the task, I will
Hello?
provide you a separate. Yeah, hello? Are you
Yes,
live?
can you hear me?
Yeah, I can properly hear you. For your task, I
Okay,
will provide a separate document, so don't worry for that. It is these slides are just
okay,
for
ma'am.
understanding like what actually the
Yes,
task is
yes.
going to be about.
Okay, ma'am. Yes.